This video is part 2 of a 2-part series on one of the most important videos you'll watch if you're serious about real estate investing in Toronto. If you haven't watched part 1, I highly recommend you watch it before watching this video. You can watch that video here. I'll also be giving everyone a free gift at the end of this video, so stick around till the end. I promise you it'll be worth it. A quick recap. An investor's goal is to answer the following 2 questions. What is my monthly cash flow? And what is my return on investment, or ROI for short? To answer these 2 questions, we need to answer an additional 5 questions. We've covered question number 1, am I buying for investment or for living? In our example, we're buying as an investor, therefore we want to take the emotion out of it and look purely at the numbers. The second question was, what is my total acquisition price? In our example, we're analyzing a pre-construction condo in downtown Toronto with an asking price of $797,900. After breaking down the price, some big incentives, taxes, and acquisition costs, we came to a final total acquisition price of $740,619.94. Now, we get to our third question. How much cash will I need to pay out of pocket? This is extremely important because without cash, this acquisition is not viable, so you need to understand this. No money, no honey. To make this easier to understand, we will divide the cash calls or cash outflows into 3 separate timelines because this is the way it typically works in Toronto with new construction. The first is prior to occupancy, second is occupancy, and the third is final closing. There are typically 2 closings here in Toronto, the interim occupancy closing and the final closing. I say typically because there are instances where you can go directly into final closing without an interim occupancy closing. Although not as common, it does happen, and I know one developer who prides himself that they always go directly into final closing. I personally believe that interim occupancy is completely ridiculous, but I won't get into the details of this in this video. I'm originally from Vancouver, and this concept was completely foreign to me, so it was quite confusing and shocking when I first encountered this. You can see from this graphic how the timelines work. This first period, from the point where you sign the contract to the interim occupancy, we will call prior to occupancy. The second is your firm occupancy, which is the day that your occupancy starts. And the third is final closing, which is the point where you officially take ownership of the property. Now, the start of your cash payments begins with the deposits. According to the developer's deposit schedules, this is how the deposits are going to be collected. I've transferred this information onto here. One thing I've estimated is the occupancy date. I just put 365 times 6 because the developer states that they expect the occupancy in 2029, and we added 1 year just in case from the previous video. The important thing to note is that the total deposit required is going to be 20% of the developer's sticker price, which ends up being $169,580. We will assume we won't be paying any further down payments as we are well over the 20% down payment requirement because in our example, our actual purchase price after the discounts is less than the developer's sticker price. Now, let's determine how much cash we need for the 3 different timelines. Prior to occupancy, we need to pay 7 deposits because the final deposit is due on the actual occupancy date. I added upgrades here because you will pick your finishes and pay for any upgrades before the occupancy. But in our example, we won't do any upgrades, so this will be $0. So the total cash outflow during the prior to occupancy period is $129,685. Next, we will determine how much cash we need on occupancy. This will consist of the final deposit of $39,895 plus the lawyer's fees, as most lawyers do charge a small fee during the interim occupancy these days, so I'll just put like $300. We won't include the interim occupancy fees in this section because most developers will allow you to rent during this period, which will offset the occupancy costs. So this total comes up to $40,195. And finally, we'll need to calculate the final cash outflow which occurs on the final closing. On final closing, we'll pay the land transfer tax, the development charges, the additional acquisition costs, and the HST rebate since we're buying as an investor. If you're buying as an owner-occupier, you won't have to pay the HST rebate. But if you have an amendment to lease during occupancy, the developer may claw the HST rebate back from you, so you'll have to claim it after your closing. So in this example, we will need to have a total of $72,586.27 ready to go as we calculated in our previous video. If we add up all three of these numbers, we will get a total cash outflow of $242,466.27. We will get back the $24,000 of the HST rebate within a few months of claiming, so we'll take this away from our total cash requirement number, so we get the total cash invested of $218,466.27. Next, we want to determine the interim occupancy fees. These are the fees that you're going to pay to the developer during the interim occupancy period. There are three parts to the interim occupancy fee. The first is the occupancy fee to the builder. This is also known as the phantom mortgage or builder's rent. This is calculated by taking the remaining balance owed to the builder. In this case, it's going to be 80% of the sticker price of $797,900, which is $728,320. We use the sticker price because at this point you didn't technically close on your property yet, so your incentives haven't been adjusted. Then you multiply this by the Bank of Canada 1-year rate, which is going to be a complete guess as I have no idea what the rates are going to be in 6 years' time. So I just put 5% as a guess here, and I'm hoping that the rates go down by then. The actual number at the time of making this video was 7.84%. I put a link in the source of this info in the description below. So $31,416 is the interest per year. So we divide this by 12, so you get a monthly amount, which works out to $2,618. The second part of the interim occupancy fee is the condo fee. I got this number from the developer's marketing package, which was 69 cents per square foot. I took this number and I simply multiplied it by the square footage of the unit, which was 488. We assume there is no parking or locker purchased with this property. If there was, you would need to add the additional costs of $149.95 per month for the parking and $49.95 for the locker. We won't include this in our example, so it will be $336.72 per month. The third and last part of the occupancy fee is the property tax portion. Typically, the developer uses a 1% of the sticker price to determine this number. Some developers will list the rate in their marketing package, but I wasn't able to see it on this one. I'll just assume that it's 1% to be safe, so we can simply multiply the sticker price by 1% and divide it by 12 to get the monthly amount, which comes to $664.92. In reality, it should be a lot less, as typically your property assessments are lower than your purchase price, and the tax rate is also lower than 1%. So the total interim occupancy fee is estimated to be $3,619.64 per month. Now, we need to estimate how many months the property will be in occupancy for. I've seen occupancy range from 0 days to more than 2 years. This really depends on the developer, as we try to look at the track record to do an estimate, but it's impossible to know for sure. In this example, we'll just guess 6 months for the interim occupancy period. So the total cost of occupancy fees will be $21,717.82. We'll be using this number later on when we look at the overall cash flow and ROI numbers. Now, you can see the summary of how the required cash is broken down on this chart beside me. So now we've answered the third question of how much cash we'll need to pay out of pocket to buy this property. We're almost there. 2 more questions to go. Now we need to determine question number 4, which is going to require you to make some assumptions and guesses. What do you think the potential rent will be on occupancy? So 6 years from now. To determine this, we need to first determine today's rental values for similar types of properties, and second, multiply it by an appreciation or depreciation rate. Moving forward, I'll just use an appreciation rate, as we'll assume that the rents will be higher from 6 years. We'll look at the lease data for comparable rental properties, or just use the average rents, which is more conservative, to determine today's rental value. Then we'll look at the historical rental data to determine a rate, which we can use to project the rents 6 years from now. Just a quick disclaimer, trying to guess rents 6 years from now is a challenging task, as it's impossible to know for sure. So this is more of a guessing game rather than something certain. And this is where your personal biases will come in. If you're more optimistic about the future, you're going to put a higher number. If you're more conservative, then you'll put a lower number. The point is that no one can know for sure, so these type of instances are where all models are flawed. So keep this in mind. Let's first start with the appreciation rate. I broke down the past 8 years of the Toronto condo downtown rental numbers by bedroom type into this table here. In our example, we're looking at one bedroom condos. So I'll look at the median price appreciation per year at 3.75% and the average price 3.5%. I'm using 2.5% for the model, which is less than our historical values because we want to be more conservative with our numbers. Plus, I believe that the rate of price appreciation will slow. You need to remember that this is a compounding rate, so it can make a big difference in the long run. Okay, let me actually just sidetrack a little so you can understand where these numbers come from. So you know that I'm not just pulling them out of thin air. I created this spreadsheet back on May 31st, 2010, and was tracking the sales market. I started doing this for the rental market on December 28th, 2013, as you can see here. So what these numbers represent are the active listings and sold conditionals on these specific dates in these districts. There's no feature in MLS to see this information, so I started tracking it manually. I wasn't that consistent, but then starting on October 24th, 2016, I started committing to this and started tracking it pretty much every single week, and I'm still doing it until today. I then started tracking every listing that was sold and leased in the downtown core on the MLS. I have done this since Jan 1st, 2017, as you can see here. So I was actually able to see each individual sale or lease that was going on. Then I took all this raw data and created tables to track each unit type by bedrooms and calculate the average and median prices, list price, sales price ratio, and days on market of each. Then I took the tables and created some graphs that automatically update as I update the data so that I can track the market weekly instead of waiting for the real estate board to publish their data monthly. I also have the ability to see if there are outliers because I get to see each data point individually. Plus, I don't trust some of the data that I see because I've seen errors in the data that I've actually had to manually correct. Also, they don't separate the downtown statistics specifically the way I want to, so this analysis doesn't exist anywhere else. So this gives me and my clients a competitive advantage as I have a pretty good insight on my marketplace. Also, when you've been tracking the market weekly for the past 8 years straight while being in the trenches, you get pretty sensitive to the changes in the market. If you actually watch my previous market reports, you'll see me go over and explain this data. I'll do another one in the future. So now you know where these numbers come from, as we'll be using them in our future videos as well. So where were we? Yes, we need to determine today's price for our one bedroom in our example. I'll use my table to determine the one bedroom rent prices for today and use this value in our estimation. I personally like to use the median price rather than the average, so I'll just use this value of $2,350. Keep in mind that many people would consider this a more conservative value for a brand new unit, but it's actually better to be more conservative because when inventory floods the market all at once from a brand new building, the rent prices are actually lower due to the competition. This is what's going on at Peter Adelaide, Time and Space, Sugar Wharf, and Nobu right now. So using these values are perfectly fine in my opinion. Now, we assume that the occupancy will be 6 years from now, so we will put 6 years here. If you look at the formula, we'll figure out the projected rent by taking 1.025 to the power of 6 because we're compounding this over 6 years, then multiplying it by the current rent to get $2,725.28. We should also consider a vacancy rate adjustment. I'll just use 2.5% because the vacancy rate is low in Toronto, but you can use whatever value you want here. With the vacancy adjustment, your rent is projected to be $2,657.15 per month. So this answers our fourth question on what our potential income or rent will be on occupancy. Now we get to our final question. Question number 5, what are the monthly expenses? I'll break this section into 2 parts, mortgages and then all the other expenses, which consist of potentially 6 items. We'll need to make a number of assumptions to get our monthly mortgage payment. We'll be using the total actual purchase price, including the HST from our previous video, as this is what the bank should use to calculate the mortgage purchase price. We'll use Jan 1st, 2030 as the final closing date, which is 6 years from now, and assume that the first payment comes due on the same date. The down payment in this example was actually almost 31% of the purchase price because if you recall, the deposit of 20% was based on the sticker price. By the way, most banks will give you back this excess 11% in cash, so you're only paying the minimum 20% down. However, in our example, we won't assume this and let's leave it as is. The mortgage principal is simply the total actual purchase price, including HST, minus the deposit amounts. The interest rate is another big unknown. There's no way to know what the interest rate is going to be in 6 years' time, so I'm just going to guess 5%. This is another one of those decisions you're going to have to make based on your temperament. We'll use a 30-year amortization to reduce the monthly payments and do 12 payments per year with a 5-year term. This brings us to a monthly payment of $2,945.59. All these values are fed into a mortgage calculator that I borrowed off this great website, www.vertex42.com. This is probably one of the best mortgage calculators I've seen, and you can get it for free off their website. I'm going to split the mortgage numbers into each year and split the mortgage payment up by its principal and interest. I took all the values from the mortgage calculator. One thing to note is that the monthly payments for the mortgage doesn't change for the entire amortization period of 30 years. In reality, it'll change as the interest rates change after each term, but we want to keep things simple in this model. One final important thing to note is that we're assuming that we'll have no issues getting mortgage financing in our example. In reality, especially in a market like today, this can be a big problem. So before buying any pre-construction property, you need to be 100% sure you're going to be able to secure financing. There are banks like RBC that'll give you a firm commitment on pre-construction properties. There will be a lot of people who lose their properties because they didn't get their financing in order, so don't be one of those people. Now that we have our mortgage numbers in check, we can now finalize the remaining expenses. We will start with property taxes. The property tax rate in Toronto is updated for the year after the budget is approved by the city, and this typically happens in May or June. I put the link to the Toronto City property tax rate in the description below. We get the property tax value from taking this tax rate and multiplying it by your Municipal Property Assessment Corporation or MPAC assessed value. The assessment usually happens about 1 year after final closing. In this case, because we don't know what it is, a conservative way to do this is just use the total actual net purchase price of the property instead. So we will take the $656,892.63 and multiply it by the tax rate, which gives us $4,376.70 or $364.73 per month. Next, we'll add the condo fees, which we calculated before on our interim occupancy. The property tax value we got from above goes into here. We estimated a monthly insurance cost here. I'll just put $50 because 6 years from now, I'm sure the insurance will be more than it is today. Today, you can get it for under $500 per year. I'll also add $5 for the utilities. You only need to pay during vacancy, but they get you with all of these setup fees and registration costs. So $5 a month should be enough for this example, as the tenants will pay for the utilities. The next is real estate fees. If you're going to use an agent to rent out your property, which is a common thing to do in Toronto, as you get the best quality tenants this way, you can put yes here. If not, and you plan on renting it out yourself, you would just put no. In this case, we'll just assume yes. We can also enter how many months the tenants turn over here to adjust for your real estate fees. I'll just use 24 months as this is a good estimate for a one bedroom. On average, a one bedroom tenant stays for around 2 years or so. And finally, you can add some repair and maintenance costs into here. I'll just add $40 per month, which works out to about $480 a year. It's a new condo, so the first year, mostly everything is covered by the warranty. Also, operating a condo is not like a house, as you'll only need to maintain the interior of the condo. And the biggest expenses typically have to do with the appliances. We'll add up all these numbers and we get a total of $924.76 per month. We'll also estimate an inflation rate at which all these expenses go up every year. We'll just use the Bank of Canada target of 2%. Congratulations, we've answered our fifth and final question, so we can now move on to answer the two big questions, which were, what's my cash flow and ROI? In our example, our cash flow is negative $1,213.20. We get this from taking the rental income after vacancy and subtract the mortgage payments and the total expenses. I then broke down the expenses during each period, starting from occupancy and then per year. I broke down the rents per square foot to see if that seemed realistic. Also, look at it from a monthly perspective, then take away the vacancy contingency and then multiply it by 12 to calculate the annual income, with the exception of the occupancy period, as you recall, was only 6 months. This gives us a total income per period. Then I take the mortgage payments per year and then the yearly other expenses. For the occupancy period, I use the interim occupancy fees and added the insurance, utilities, and real estate agent fees. After 1 year, you can see that the expenses go up by the inflation rate, which we assume to be 2% every single year. This then gives us our total expenses, or more accurately, your cash outflow, as your mortgage principal is not actually an expense. We'll address this in the next section, but for the cash flow analysis, this doesn't matter. You can see that during occupancy, you're paying out of pocket almost $7,000 in 6 months. And in year 1, after closing, you're paying out over $14,000, and in year 2, another $14,000. And then you keep paying out of pocket until year 21. We'll come back and talk about this in a bit. Now let's analyze the ROI. We now come to the final question we want to answer. How much money is this property really going to be making us? For those of you who don't know, the return on investment is basically this. If I invest X amount of dollars, how much money is this investment going to make me? To get this, you simply divide the profits or losses by the initial total investment to get a percentage. For example, if you invest $100,000 into an investment and you make $10,000 per year, you're making $10,000 divided by $100,000, which is equal to 10% per year. So 10% will be your return on investment, or 10% ROI. In our example, we'll be looking at the ROI every year we hold the property, and then we will look at the ROI when we sell the property. So to start this off, we need to make a few assumptions. First, we need to determine what the current market value of this property would be if it was completed and on the market today. Yes, that's right. We can do this by looking at the sales price of comparable new properties that are on the market today. I'm not going to go into the details of how I did the market analysis in this video, but I'm comfortable using an estimated price of $650,000. These days, the developers charge a premium for new construction properties. I can explain some of the theories on why, but that's a discussion for another time. All you need to know is that this is the case, and it's very obvious when you compare resale to new construction pricing. This is why my estimation for this property at today's price is much lower, because I can get a comparable brand new resale property for a much cheaper price. Next, I'm going to determine a real estate appreciation rate that will be compounding every single year. I'm going to use 2%. In reality, it was much higher if you look at the past 8-year period from the data I've been compiling here. But I'm going to use a more conservative number because I think there is room for the prices to come down further before changing course. And I don't think we will have the same rate of a growth for the next 8 years as we did for the past 8 years. Again, this is something you're going to have to determine based on your own investment thesis. Now, once we enter in our appreciation rate, it will give me an estimated price on the closing. $650,000 with a 2% growth compounding over the next 6 years gives us $732,005.57. We'll also need to enter in the real estate commissions when we sell, so I'll use 5% because that's typical. And as I mentioned at the start of this section, we need to get the total cash we've invested into the property to calculate the ROI, which is $218,466.27. Now, let's take a look at the ROI on our rental income. I've broken down the rental numbers here by price per square foot and the monthly numbers. You can see that every year the rental income increases with the appreciation rate that we determined earlier. If we recall, we estimated that rents would grow at 2.5%. We also took into consideration a vacancy rate of 2.5%, so we subtract that here. Then I took the yearly rental income by dividing the difference of the rent minus the vacancy and then multiplying it by 12 to give me the yearly amount. The only exception is the occupancy period, which could be longer or shorter than a year. In our example, it was 6 months. Then I calculated the expenses, which is our mortgage interest, plus all the other expenses we use in our cash flow model, and got the total expenses here. Then I calculated the profit or loss by simply taking the income minus the expenses. You can see here that your expenses are a lot more than your income, so you're taking a loss of over $6,800 during your interim occupancy period and over $6,400 in year one. I then take the profit or loss and then divide it by the total cash invested to get the ROI. You can see that the cash invested during occupancy is less because we didn't pay for all the final closing costs like land transfer tax and development charges. In year one, we did pay for this, plus the loss of $68,74.83 during the interim occupancy period. If you recall, the initial cash invested number takes into consideration all the acquisition costs. So if you add this extra $68,74.83 to the $218,466.27, then you get $225,341.09 of cash invested. I add back all the loss to the initial cash invested because in reality, you're technically still investing your money back into the property. It's a cash injection into the property to carry it. So based on this, you can see that your ROI is minus 8.09% during occupancy, minus 2.87% for year one, and minus 2.43% for year two. It stays negative till year 7. So basically, you'll be losing money every single year on this for 6 years before you start making something back. Now, let's look at the scenario if you want to sell. I put our initial price assumption here and then divided by the size of the unit to get the price per square foot value. The sale price will be our income. So now we'll need to calculate all our expenses for selling. The biggest expense for selling is your real estate fees, which I calculated here, which is 5% of the selling price. There is also HST on the real estate fees as well. Then we'll add the lawyer fees. These are basically the two major expenses when it comes to selling. Then I took the sale price and subtracted the expenses so I get the net price. Then I subtracted the remaining mortgage at the end of the year, and in the case of occupancy, the remaining balance owed to the developer to get my total equity in the property. Then I subtracted the total cash that I invested to get my net profit or loss. Then I took this number and divided it by the total cash invested to get my ROI. As you can see, if I sell this property before year 5, I'll be taking a loss. If I sold it on assignment, my ROI would be minus 1.99%. And if I sold it in year 1, my ROI would be minus 34.31%, which is just over negative $77,000. The last thing I'll include as a bonus is the break-even analysis. I look at 2 break-even points: before closing, if you sold an assignment, and after your final closing. I put in a very important question here. Are the incentives passed on to the assigner? I've seen some developers put a clause into their contract that none of the incentives and caps can be passed on to the assigner. In our example, if you mark it as no, it just removes the incentives, so we didn't take the development charge adjustments into consideration. I did this to keep it simple because if the development charges are not capped, then they'll add tens of thousands of dollars to your acquisition costs, and there is no way for me to know this final number. Let's just assume that they are in our example. So to break even, you need to assign it at $733,816.63. And if you sold it after final closing, you'd have to get $784,464.97. Now, before we get to the conclusion, we need to shine light on the flaws with this model. I'll just quickly list them because each one of these topics are their own rabbit holes. First off, the assumptions are all based on arbitrary numbers that we'll never know for certain until that time comes. The big ones include the following: the interim occupancy rate, which is based on the Bank of Canada 1-year rate, the time during the interim occupancy, the final development charges, the potential rental income, the rental income growth rate, the vacancy rate, the property tax rate, the mortgage interest rate, the inflation rate, the price of the property today, the real estate appreciation rate, and finally, the assignment adjustments if development charges are not capped. Some of the smaller assumptions are the lawyer fees, condo fees, insurance costs, utilities, and your repairs and maintenance. All of these variables will affect the final numbers, so it's best to take a more conservative approach when assuming these numbers, which I believe we have as I've covered in each section. We're also not taking into consideration the mortgage penalty or fluctuations in interest rate, as we have a fixed interest rate for the entire amortization period. Also, we don't look at the taxes or the time value of money. Finally, this is something that I've seen many real estate investors and agents do that I want to bring to your attention. Taking a straight line compounding appreciation is dangerous because in reality it doesn't work like that, because there are times when the market goes down as well. There is also a price threshold that the market can bear. For example, you can't keep increasing the rents until infinity if the overall incomes for the tenants are not rising or the demand severely drops and supply increases, like during the pandemic. I've seen models from agents that do this and say rents are going to increase every single year and be like $5,000 for a one bedroom in like 10 years, or that their portfolio will be worth like hundreds of millions of dollars in 20 years. This is not realistic because they're using a flawed model. So be extremely skeptical whenever you see rents or prices rising on a straight line compounding appreciation. Our model does this too, but that's why we want to be more conservative on your rental and price appreciation numbers to counterbalance this. I think I've covered pretty much all the flaws and things you need to look out for in our model. If I missed anything, let me know in the comments below. Although there are these flaws in our model, at least you now have a baseline understanding of what your numbers will look like at the end of the day and something to work with. The more you use this model, the better you'll understand your investment and come up with an investment plan that'll work for you. The point of this entire exercise is to shine some light on what you're about to do, because it's probably one of the biggest investments you'll make in your life. Now let's draw everything to a conclusion, as we now have answered our two big questions: what is our cash flow and ROI? Based on all our assumptions, if you purchase this property, you'll have a negative cash flow for 20 years. After investing $218,466.27, you'll have to potentially pay out another $168,636.35 over the next 20 years before getting any positive cash flow. Keep in mind that we're not looking at the principal that's being repaid on your mortgage here, so we'll look at the ROI numbers for some more context. So let's take a look. If you hold a property, you're getting a negative ROI until year 7, which means that you're not making any money on this property until year 7. And if you did decide to sell, you won't be able to make any money on the property until year 5. I don't know about you, but losing money on my investment for 7.5 years and then having my money tied up for 11.5 years, 6.5 years for waiting for the property to be built, plus another 5 years to just make back my money, doesn't seem like a very good idea to me. I can park my money into a GIC these days and get 5% with zero risk. Unfortunately, there were probably thousands of people who made this similar decision to do this, and therefore we're in the current situation we're in. I'm pretty sure many of those people would have never bought in the first place had they known that their numbers were so bad. Some of you might say, well, the interest rates were a lot lower back then and we didn't expect the rates to go up so fast. Well, now that we have this model, we can test this theory out and see what happens. The fixed rate was about 2.5% at the time, but since the property is going to be finished 6 years later, I would have added another 1% at the time because I never expected the rates to stay this low. So it was prudent to estimate a higher interest rate into the future. So let's see if the numbers make sense with a 3.5% interest rate. We can go into our model and change the interest rate to 3.5% for the mortgage and 4% for the interim occupancy period. Now, it's still showing a negative cash flow till year 13, but your ROI is still showing that you're making about 1.03% in year 1. And then you'll recover your total investment in year 2 if you're able to sell the property. So that's 7.5 years of tying up your money. Personally, I still don't like these numbers, as there are other investments where I can make more. Plus, I like to make money on my investments as soon as I purchase them. The smart investors make money as soon as they purchase, not on speculation that the prices will go up in the future. You might as well just go to the casino if you want to invest like that. In the future, I'll show you some other examples using this model, and we can play around with different scenarios to see what the different real-life opportunities look like. At the same time, we'll continually improve the model so it gets better. As promised in the beginning, if you made it this far in the video, I'm going to reward you for this. I'm sure that some of you don't have any idea of how to use this spreadsheet or just don't have time to create something like this. So as a free gift to you, I'll send you a copy of this exact Google spreadsheet that you can modify and test your own scenarios on if you go to my website link in the description below and ask me for it. So you don't have to build this from scratch. I don't want this to get out to everyone, as I've spent a lot of time building this. So I want to send you a secured version for your own use. This is my thank you to you for subscribing to my channel and watching the video up to this point. I can see that you're serious about learning real estate, so I'm here to teach you and share all I know. Now, if you want to take this to the next level and make this model even better, you can do this one final step. I challenge you to organize all the variables in your model onto one page and then summarize your most important values onto that page so that when you adjust the variables, all the numbers update right before your eyes. I'll let you figure this out, because if you can do this, then you'll be at the next level and we can start discussing how we can better estimate the assumptions, because that's the most difficult part. If you don't want to bother with this but still get a detailed analysis on your property, I can help you with that as well, with full confidentiality. You can reach out to me to request a detailed property analysis in the link below. My goal is to help educate you so you can go into a real estate transaction knowing everything you need to know. As you can see from the amount of detail from this video, there is still a lot of information to still cover. There are another like 16 different topics I can expand on from here, which I'll release in my future videos. So if you're learning from this video, hit the subscribe and bell notification button to keep up to date with the content I'll be posting to this channel. Also, if you know anyone who would benefit from watching this video, please pass it along to them, as I need your help in bringing everyone's real estate game to the next level. The problem with our real estate market is that people aren't really educated on how to look at their real estate investments. They call themselves investors, but they're really just speculators. I don't blame them though, because they're being led by the blind or just misinformed. As you can see, it can be overwhelming if you're not familiar with the numbers and regulations. That's why I'm hoping to shed some light on what you need to think about from my own personal real estate experiences. Until next time, I'll see you in the next video.